Just want to hit record button for myself and we can get rolling. Remember, trading futures involves risk. It is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. Um, but if you do want to talk to me more about how to create a trading plan, different risk management strategies in these environments, what are different technical indicators, fundamentals, Dan, help me walk through what a trading plan looks like. That's what brokers like myself are here for. That's what market strategists like myself are here for. And enough of the advertisement about what I am and what I do. You should all be somewhat familiar with it, but not many people are. Um, we are here to talk with you. My number on the screen there, 312-277-0110. Don't give me a call right now, but definitely give me a call to talk about the markets, to see about opening an account and what we can't do for you. You can always find me here on Facebook and Twitter, and shoot me an email at dhussey@zaner.com. So this week was really, marred by, effectively the WASD report at the start of the week that, okay, how much did that report play into market price action? It seems like, right, if you just take it at face value, it seems like, right, it was generally, a positive week for so far for corn and beans. Wheat is a little more negative. What can we do? What are we left with, right? I feel like you're just left with a lot more questions than answers. I know consensus as to how bullish or bearish we are, and I think that really speaks to the bigger ranges we've been in. It's a broken record. It's been a year almost now of talking about them. Let's flip over to the daily charts and just start banging through them. Let's start with corn here. Let me give me a second while some stuff loads up. Okay, so big old range. I got beans up, of course. May corn, there we go. Big old range in May corn. We've been talking about it. I feel that another week of discussing it is just a waste of time. But it has to be said for those that haven't been here and that haven't been a part of the discussion. 580 to 760 in May corn has just been a sideways range. Downward sloping trend lines against the highs. We seem to be kind of generally coming up into that resistance area and still holding it as resistance here into this week. The cluster moving averages, the 55-day here at 653, the 100-day here at 657, and the 200-day at 658. All bear the bear case of, hey, we're banging into resistance for now. We came out of oversold conditions on the daily chart. We went into overbought conditions. Now we've unwound those overbought conditions. We've come back more towards neutral. And being neutral right in the RSI, we're not neutral in the whole range. We're still at the top 25% of the range. So that to me suggests there's maybe more room to the upside. It's like a pullback to neutrality like you saw back here, where there's a pullback that eventually leads to another test of resistance and more overbought conditions. And nevertheless, markets don't repeat themselves entirely, but okay, that's a good example of upward sloping trend lines against the lows form that down, the lower bounds of like a triangle structure. And if this is a triangle, A, B, C, and this is part of D, D could still be up to 7 before E wave, whatever. But it's hard, in my opinion, to not talk about corn above 680 and be bearish at this point. Now, we're not above 680, we're at 650. We're right in the middle of this range. So it's hard while we're below that 650 to 660 area to be bullish corn, because technically speaking, we're on the low end of the range. 18-day moving average is the move. The market moved back above that 18-day moving average. That's like my short-term kind of trend signal. It's in the commodity space. It's just it's one of those trend indicators Grandpa taught me that's always worked, right? It's particularly in the softs can really be an indicator. Anyway, we came back to test it as support. Doesn't mean it can't test again. It's just we're above the 18-day moving average, right? That's a bullish sign potentially. real quick, December corn, and we'll flip over to the 4-hour charts for corn because I want to keep things moving and try to keep everything less than 5 minutes on each chart today, so that you can get through everything and get everything a little bit of safe spike. December corn 550 is at similar support area. Come back down to test it every time. Below 550 scares me a little bit, right? Capitulation towards $5 I think could happen in a hurry. December corn, we're below that 18-day moving average. We're below the 100-day, 55-day, and 200 days respectively, below our trend line. So I'm a lot more bearish December corn than I am, May corn. Certainly when you look at old crop, new crop spreads in beans and corn respectively, which we'll look at in just a minute for corn, and then we'll look at beans later. You can see that obviously we've still been bull spreading in a pretty dramatic fashion. To that case, here is your July-December old crop, new crop spread. It is the, epitome of the end of one crop year and the start of another. Very much range bound between 50 cents over and 70 cents over. That 20-cent range, though, above 70 cents over at this time of year, if you go back and look at what this I don't have it up here right away. That's okay. If you go and look at it in years past, this can go $1.50 over. Usually it happens in peak, fear supply for the summer month time frame. But nevertheless, we might see. I mean, the way beans are trading in their old crop, new crop spreads at almost like $2 over, it's just staggering how wide we've gotten in some of these spread markets. And that kind of brings me back to a discussion I've been having with most of my clients recently, because many of us are sitting here scratching our heads like, where are the trends, right? We just came out of this big trending market, inflationary market. Everything was trending last year. Now everything's like went counter trend, just deflationary. We unwound that inflationary move a lot. That's great. Now there's no trends, right? Well, there are trends in some of these, spread markets, and the spreads are really moving around. Chicago or old crop, Chicago talk a lot about, and we'll come back to, right? Look how it's trended higher, right? In a bear market for wheat, right? If you look at the, do I have wheat corn up here? I don't have it prepared, and I feel like I need to just do an entire video on that. But look at the wheat corn spread. Oh my gosh, it's like 13 cents difference today. It was like within 10 cents. What? That's kind of remarkable. It was 15 cents difference here at the settle between Chicago wheat at 667 and May corn at 652. Wild. So, nevertheless, that old crop, new crop spread for bean or corn trading at 72 cents over towards the high end of its range. This needs to, in my opinion, kind of break out to keep the bullish attitude going, to keep bull spreading. I think it could. Today was a day where we settled negative and back down inside or unchanged on the day. Could be a little toppy into the high end of the range, so be aware of that. But again, this is an opportunity for it to break through, is, I guess, my overall point there I wanted to make. All right, on the 4-hour chart for May corn now. I did get, personally, I think, in my opinion, I saw some reasons to, have been a buyer today. So I'm messing with my screen, and I shouldn't be. Okay, so we came up off of, right, we've talked about the bigger range, come up with the low end of the range. Every time, we've drawn up 50% lines between the highs and lows of the range, they tend to not hold or get broken, or they hold for a little bit, but then the opposite side holds. And right, there's a justification for both sides fighting over the trend. Corn, in my opinion, had been on a, kind of a stair-stepping move. I'm going to remove some stuff in the charts, and we'll just kind of walk through this price action because it's kind of technical, and I think that's a good, good little look. Trend line against the lows here, arguably kind of held, maybe it kind of broke, but it's been fighting to hold is the point, right? And some kind of like little trend channel higher. I give these, on the 4-hour time frame of low, I give trend lines, a little bit more leeway to break and come back in, right? On the dailies and such, right? I like to see closes above and below to really confirm. But point being is that it seems like there's some supportive, you know, algorithm buyer, somebody buying up the dips still. Corn began a pattern of, basically 2 steps forward, 1 step back, 2 steps forward, 1 step back so far in this, 622 swing low to high. But arguably speaking, from the 607 low to the 668 high, we came within a couple pennies there. What's 2 cents, a bit of a front run there. Let's call it 638, rounding up there. I would not be surprised though to see corn, do one more leg lower down into that 635 to 630 area. It's the old in the near term, right? It's the old, cluster of highs that we broke out of. Um, they're into the middle of March. We broke out of it here into the start of April, and April's first, test is a move lower to test that area of support, in my opinion. So kind of a reason to be a buyer there. It's also the old support here from back in December. This, move below 640 looks like capitulation down into the low end of the range, move back up to the high end of the range. This is a shot, in my opinion, for the market to, potentially go higher now and break through highs towards 670. If it really gets bullish, this is an opportunity for it to do so off of the 668 high, and why today, to me, was a bit of a buying opportunity. The high to low here. We can basically drop 50% swings from all the swings from lows to highs right now, and they're all holding. But from highs to lows, the shorts, they're 50% swing. Well, the move a couple days ago was up into that 654 area, that 50% area, but then we nearly got the 628 line. We got a reaction, couldn't break down to new lows, and then actually started and continued a series of higher highs and higher lows, which is like by definition the most basic definition of an uptrend there is. Anyway, higher highs and higher lows all the way up. We break through the 628 line. The market technically invalidates that short. And now from the 640 low to high, did the market just make 2 steps forward, 1 step back on a smaller fractal inside of a 2 steps forward, 1 step back? And is this market's making just 2 steps forward, 1 step back, right, and about to break out of resistance? Well, 670 is definitely the line in the sand in the near term. 661 highs of the day certainly matter, but above 670, I can make a very good case for how now you're really breaking through resistance trend lines. Next area of interest is that 685 to 690 area, and really, you call into question, is Maycorn not going to potentially hit new contract highs? Now, there's a lot of fundamentals that can come into play here to knock that ping pong ball one way or the other. But at least technically on a chart, I'm seeing some trend line support. I'm seeing some reasons to maybe be a buyer in this trend higher. Some very clear lines in the sand, below 650 again, calls into question 640, and again another test at 640. Okay, now you're just going back down in the range from whence you came. There's upward sloping trend lines. There's a good reason to maybe not be too committed to longs if we start to break below 645 to 640 again. So 2 lines in the sand as a market finds a small range and a fight over the trend in a larger, bigger picture could be coming off the lows. Let's see if momentum takes it through. If it doesn't, we're just heading up into resistance once again and could roll back over inside the range we've been in. That was a lot to tell you that we're still in a big range. But in the short term, today got interesting. If we're going to break out of the range, right, markets make these goes of it, if you will. At times. So May beans, also very range bound, but here I think we've got more of a ceiling that we're knocking our head against or banging against. In the near term, that 1480 area was really a line in the sand. We capitulated below, whipsawed right back above. Now we're right in the middle of that range that we were in from between 1480 and 1540 before, closing today around 1500. Back above $15. I mean, it's bullish. I guess, today's close wasn't great in terms of, leaving ourselves 20 cents off the high. But again, it's still higher highs and higher lows. I am fearful, though, that, a pullback towards 1480 isn't out of the question here and would be 3 waves back. We looked at corn just a minute ago. how, okay, well, could it have, another push down towards that 635 area and then, be two steps forward, one step back, three-wave correction after maybe five swing up if you're an Elliott waiver um, into a nice corrective structure. I would prefer to see us just stay above the 18-day moving average, keep higher highs and higher lows. Tomorrow, rocket back up to highs and take out, and do one of these, push up there, come back down, push up, and then go through kind of things. I have no idea how it's going to happen, but hey, if there's an opportunity for it to, there's one staring us in the face. 1540 area is still very much resistance and has been. We're seeing resistance come in now a little ahead of that range into the 1520 area. Okay, maybe a downward sloping trend line now against the highs that we need to respect until um, until it's broken. Um, Market came off of the $14 figure. Really not much else down there. Make a case for some kind of maybe upward sloping trend line against the lows, though. From lows of prior years through lows of last summer, and et cetera. We just shot through 1480. I think the market just went down as far as it needed to and came right back up above 1480. This was capitulation to me. We're back inside the range. This is a very interesting inverted head and shoulders with the right shoulder could be forming at the 1480 to 1470 area with a neckline of 1540, which would be breakouts to new contract highs, which that's exciting. But I still think there's going to be quite a bit of a fight over the trend in sideways price action here between 1480 and 1520 in the near term. So, all right, well, the pullback we saw is an opportunity for the market to, bounce and head higher. Just over the last couple of days worth of price action, we could be retesting 1480 before heading higher. And that's something that makes me a little nervous in the near term. Today was a day I'm surprised we didn't, test 1540 to be perfectly honest. But that's what happened. All right, so upward sloping trend lines now in the soybeans have been very aggressively kind of holding here. Some like channel multi intraday. Like the corn, off the highs there, if there's any kind of 50% short, that was holding at 1505. It broke, and then maybe just from the 1482 lows of now the month of April to the highs. Of the last swing at 1502, also $15 psychological support. I can make a case for us, holding here or around this area and continuing higher, right? I would almost prefer us to head down to 1480 to 1470 to clean up the chart and then head higher, but bullish markets, big pullbacks like this, they end up being bear traps. Just like, when you look back, when we were bouncing off these lows, right here, this looked like a really good reversal, right? But in reality, this random Thursday, I just picked on a chart, 316, interestingly, a month ago, looks like a really good reversal, right? We are in a downtrend, and this looks like a good reversal to be long. And in reality, that day was actually, if you look where we closed, we actually closed quite positive here, right here, like 1494. That's like almost 20 cents off the lows. That was a great time to just be short against that high. Look at that. You could have sold 1495s, risked 3 cents against the highs. Your stop was never hit, and the market still was never technically hit here. But the market went 30 cents lower and even far beyond. My point being is that markets can look and close a day very one way and then the next day be very opposite. Soybeans does it routinely. If we had a bit of an uptrend here and this looks like a big reversal lower, it could very well be a bear trap into tomorrow. We just don't know. But I know that a line in the sand above $15 makes sense to me. So if I'm a buyer in the beans here, I really don't want to give it more than 14.95 to 14.94 in the near term. And then below there, I'll get interested again below 14.80 and see how it lands around 14.70 to 14.60. I hate these choppy, kind of worthless trends, in my opinion. The bean complex, has seen some little bit of volatility recently. Bean oil, Okay, for the last week we've just been fighting, um, and in my opinion, trying to fight and break back above that 18-day moving average and just been failing to do so. Today was the first day we didn't really even come back to touch it in a while. Um, we're up back down to this 50 to 54, kind of range low. Um, we broke below our old range low there at 58. That's the level that we need to retake, to reverse the downtrend that we've been in. Uh, in the very near term, maybe a little 50 back here we were hoping was holding. It doesn't seem like it is. I need to see us get back above now the 54.90 18-day moving average and above highs of yesterday and the day before. And then, 58 and above to feel more comfortable with the bean oil. Canola and palm oil. Palm oil here first, though, came back down to test the 18-day moving average, which we got back above, and it's holding it. Palm oil just looks different, right? We just were unable to break below that same seasonal low in the summertime and last year, that bean oil was holding above, that we've now started to go below. Palm oil is, basically still in that range and holding above. Not much to say there, but just reverting back to the canola, like the bean oil, broke below that same seasonal low and support. We've come back up to test it as resistance here into the 770 to 780 area. I don't love that. That looks, like a market that's ready to go back lower. But while we're above this 18-day moving average, there seems to be a fight between this old support now as resistance and that 18-day over the trend. So if we do push above, 780, I'm interested in being a buyer, for a move above 80 or 800 and towards $8 towards the up downward sloping trend line, and then above there, that's where we really reverse this whole downtrend that we've been in since July. But it's a big ask for that market right now. But that's how things, sometimes begin. In the bean meal today, finding resistance in that 55-day moving average, it looks like a 50% short off the highs to me, but it also looks like a much larger 50% long from the swing low here from 373 to high. So I think you got a bit of a fight now, 440 to 470. We get above today's highs. I think that's a big breakout indicator towards $5 again. But yeah, 440 support is continuing to prove itself. If it gives way, I feel like we will be back down to $4 in a hurry, given we've just accelerated through that point in the past. But um, it does very much look like a market that's broken through resistance, come back down to try to test this support in a bigger way, and might be finding a bottom. So we'll see. Bean meal and oil. We need you guys to lead the way for the soybeans here. Otherwise, it's very hard pressed with where crush margins are right now to imagine beans rallying. If the meal and the oil can't. Chicago wheat kind of looks like those oil complex charts. You know, the spring and the KC wheat are obviously better bid to the Chicago to the tune of like $2 now. Not quite, but there's a reason they're driving that premium, and they haven't sold off as much. But boy, oh boy, at some point, when have we gotten too bearish the wheat? Coming back down to test its range low now at 660. Downward sloping trend lines, the 18-day moving average. There's not much bullishness I can say about this chart until we get back above. At this point, today's high at 680. That's a big line in the sand now. While we're below 680, I think we threaten to break down and accelerate lower. And at this point, why not just go to $6 Chicago wheat? Why not go below the 652 corn price? We're 15 cents off of that. That's gotten incredibly narrow in that corn to wheat spread. Um, I don't think that'll stay that narrow for this long, but we will see. A 55-day moving average up around 722, 100-day up around 743, and 200-day up at $8. I do think we will get back to test $8 at some point, at least 750, but it's a downtrend until it's not. I mean, there's literally not much we can do or say there about Chicago wheat. Down 18 cents today in the May KC. I think you just needed to kind of sober up and come back down with Chicago, but pulling back into full 50% retracements and upward sloping trend lines for the KC wheat. It's not exactly super bearish. or is bearish. We did get rejected there at the $9, the 200-day moving average, and this, kind of inflection zone and resistance at highs. There's downward sloping trend line against the highs that we broke through though, and have come back down and tested support. Um, we take a quick look. Uh, there we go. Oh, forget it. I knew I had KC up here somewhere. Okay. So KC wheat, right? There's the trend line we're kind of breaking above. Here's the full 50% long from 772 half to highs, right? Three waves down, beautiful three waves. Those three waves were also in equal legs. I mean, as a technician, that's about as beautiful of a little supportive area between at 837 and confluence of fibs as I've ever seen. Um, Upward sloping trend line against the lows comes in around 830. So this 839 to 830 area I think is supportive for the KC wheat, and it arguably should be the leader. Well, I feel like spring wheat should be the leader, but okay, KC is a little more liquid. Again, we rally back up above 880. Things get a little more bullish for me, but three waves back into this full 50% long. If you're going to be a buyer in the wheat, be a buyer in the KC wheat and do it in that 50% pullback. We shall see what happens. But I wanted to at least point that out there on the 4-hour chart real quick. Minneapolis spring wheat looks pretty abysmal. On the chart too, and technically ran up, hit all of our resistance zones, downward sloping trend line. This old support now resistance around the 890 to $8 area, and has rolled over. The 50% area around 860 is kind of breaking a little bit here, which is not good to see. And the trend line against the lows is pretty much at its line in the sand. We just hit over, but we just closed oversold. And with the weather conditions and everything else going on in spring wheat, all I can think is maybe we're just, slowly carving out a bottom. But I find it very hard to be bearish the spring wheat given the conditions we've got out there. But maybe the market knows something more than I do. Certainly, market made two steps forward and one step back, but it's got to start making two steps forward again here. And proving itself because day over day, this is definitely a downtrend until it's not, and we're downtrend that's pressing itself against the line in the sand for many bulls in a real way. All right, let's talk cattle real quick because I think cattle might be gearing up for a reversal here. The June cattle falling from the 166 handle. October is my other place I'm interested. Falling from 168 down to 166. So gap fill here 164, and then again down around 160 potentially. Um, anyway, um, I fully intend to see us, or fully expect this market to come back down and fill those gaps. We take the sometimes can take blow off in the cattle. There's certainly reason to be bullish cattle and things that we can um, things as they stand right now are continue to be bullish. Um, but today's outside day reversal lower in the October cattle. Sorry, got a little distracted there. April feeders coming down again there too. Point being is that this looks like we could have a top forming. We'll dial down now because the big levels below is 208, 158, but I think coming back towards this 163 to 160 area, anyone looking to get long cattle, That's where I'm going to be looking to structure the trades. Getting short in the near term, though, I don't think is a bad trade. Stops can go above the highs, and there's a reversal setup underway. I don't think it's really given me a setup until tomorrow in the confirmation, but thereafter. But I do look for cattle to come back down. And now we've got open gaps and downside targets. 18-day moving average at 163.89, the 55-day at 163.49 there for October cattle, and 162 there the 100-day. All I think viable places for this market, for the market to come back down into. Let's take a look at the short-term or the setup on the June cattle for the time being. It's our near-term contract. We get the 4-hour chart up here. Let's not forget, we just had a swing that held a 50% pullback in that 154. So for all intents and purposes, we need to be aware that the market could pull back from 154 swing low to high. All right, we'll remove that old swing. That 50% level around 160 is right around that open gap of 160 here on the June cattle. So that's a $4 decline from where we are. The open gap that we have below that at 156 is about an $8 decline from where we are. October's, makes sense to come back down to the 18-day to test, 164, those old highs. Makes sense to me is a first target. So, tomorrow, if we start to slip below 164 in the June, and certainly for the October's below 166, I think I, would either look to sell with momentum lower or on a little bit of a rally, stops above, the contract highs, or even use it as a reason to get into puts for that move down to these gap fills in the near term, where then I might actually consider being, flipping long, but I'm going to wait for those levels to trade, right, and see how they react before hopping in. Feeder cattle was not the leader here, but they might start being the leader to the downside. The April cattle, is only spent, a few days here above 200 this week and last. We slipped back below. I think this unwinds very quickly. Open gap at 198, at 194, and then all the way back here. Don't forget about this one at 185 on the feeders. So, do we unwind basically the entire rally of 2023, and how much of it do we dip down into is going to be the question. And I'm not saying this is necessarily the top just yet, but I think with some momentum and into tomorrow, I think today was enough of a reversal to say some degree of a high has formed for the cattle, and that's going to be, also be a little helpful and be a little more bullish for the for our row crops as well there, usually with a little bit of an inverted correlation at times. What should we move on to? Let's just take a quick look at our cotton. May cotton and December cotton all floating around that 82 to 83 area. December cotton effectively pulled back into a full 50% retracement there, this 78 area, this kind of choppy uptrend, and we found our way right back up towards 82. I think a breakout of this trend line that we've been watching against the highs at 84 is, I'd like to say, hopefully underway, that we're finally back above our 18, most of our moving averages, with the exception of that 55-day there. But I am bullish. I think we're due for breakout. Today was higher highs and higher lows in both contracts, and again here you can see that 84 area on the May cotton chart, important I think for a near-term breakout of those moving averages for a move back towards the test of the 200-day at 86 and the high end of the range that has capped us below 90. I'm hoping this is the move that will take us back above 90 towards 95 and 100. Buy some acres for cotton. If it's even too late to do, I think it's a little late to do that. But the idea being is that with where cotton is priced, we might come in short acres, right? So the supply we have might be worth more, and there may be a demand and need for it. So, yeah, I almost think, right, I think there's a higher probability of December cotton getting to 90 to 100 than May at this point, but a bull swing should, affect them both. Dollar continues to decline. Remember when we go back over this last year, we were looking at the dollar. Got a continuous chart up here of that dollar index for us. There we go. Big blow off above 100, right? We're coming back down now. We got a rally that we were watching there back, could have gotten as high as 108 as we discussed. Didn't. It stayed below that 100-day moving average and below the 200-day moving average. And boy, we rolled right back over below that 18-day, tested the 55-day as support, 18 days resistance, went through the 55-day, tested resistance, resistance, resistance. This is a bearish market and a bear trend. No ifs, ands, or buts about that, in my opinion. And I hope many other people should be shifting their hats here on the dollar bulls, of which there were a lot back in February. I hope you shifted your hat now and are considering that break below 100. And of course, what that could mean, when you go back and you look at the old range that the dollar was in for the previous decade, it was all below 100, right? So we could unwind down to 90, and then, okay, where do we go from there? It's high time the dollar becomes devalued in an inflationary market where generally the dollar saw a flight to quality, which is really weird, wasn't it? But I think this is the cycle, part of the cycle where you're going to see things like gold and silver really go crazy. I do think oil will probably get back to $150, and I think that'll all be happening with a falling dollar relative to other baskets of currencies because of, various need to slow down interest rate cycles. Basically, the U.S. will start lowering interest rates. Is a good way to make the dollar fall. Is kind of the idea, and I think that's what the dollar's pricing in as well. So we're going to flip now over to crude oil, and we'll get through the rest of gold and the S&P here real quick. Crude oil finally breaking, back above that 80 figure, the 82 handle that we talked about, the resistance and the downward sloping trend lines that we're breaking and nesting above, finally moved above, head towards the high here, new high of the month here of 83.40 today, or yesterday, and today kind of flagging above. 82 is now being tested as support. It's the resistance we held all week. It's just back and fill price action to me. As long as we're above 79, I think crude is still heading higher towards 90 and above. Back below 80, whatever, fill the gap at 75, probably get as low as 74 to 72 again, maybe even as low as 71 in an otherwise bull trend. Flip over to the continuous chart for crude for a second, to take a look at how far we've been from $6 back in the pandemic lows to 129 highs. We pulled 50% retracements in the 68 area. Upward targets are for 160, and the market really just pulled back after breaking out of these three highs from 2021. Pulled back to test that area, broken resistance, now is support. So get through these trend lines that we've been talking about, and one of them was kind of at this 75 area, 80 to 82 area. We're kind of through them. I don't see much in the way on this chart until we get back up to these highs around 90 to 92, and above there it's 100, the psychological level, and then prior highs at 120 to 130. So that's where then the craziness takes off. Maybe crude has finally done it. So good reason to continue to think the commodity complex might be getting a little bit of inflationary pressure back. Gold is confirming that ideology with, I guess you have 1600 lows to 1975 high there, front run at that 1800 area. Boom, right through highs and back to the high end of the range. Gold's been in a range for the last several years, so don't, get too excited until we break out. But boy, this move does look like we're going to go above 2100, 2200. And honestly, three ways back for gold into that 1624 area. Upside targets are 2,297. Let's call it around 2,300 bucks for the gold with extensions toward 2,600. So in the near term, though, got to imagine gold's going to have support now from the 18 swing up around 1950. It's that old high as well. We know it's proven support 1930s to the 1960 area here. Now we're proving support around 2,000. So look for gold to stay above 2,000. Next support below that 1940 to 1900. Below that, we're really talking about retracing the range. But for the time being, gold's in a uptrend and a swing higher for sure. And last but not least today, let's talk about the S&P 500. And I'm the bull who won't give up. Anyway, this downward sloping trend line we talked about a month or so ago, we started to break through it, right? This is all the process of breaking out of resistance. It's not so easy sometimes. We've been gnawing away at the ceiling and where resistance is. All the downward sloping trend lines you draw on the chart are eventually breaking, and then holding as support as you pull back. Upward sloping trend lines in the chart weren't holding there for a bit, but now they're starting to hold a little bit more. And even though we kind of have this range between 3,800 and 4,200 on the S&P, we're putting pressure on the upside of that range, and above 4,200 opens the door to, I think, breaking and invalidating the full 50% short from the 4,800 high to the post-pandemic swing low at 3,500. And remember, from that swing of the lows of the pandemic to the highs after, just like crude, we pulled into that full 50% long around 3,500. I have upside swing targets of 5,400 and potentially 6,400 in the S&P. And this is all just the market of how it breaks its way through resistance before eventually rallies and pulls back to 44 to 4,200 and finds support before rallying to 5,000 and beyond, right? Like nothing's a straight line. We see the support and resistance as they're fighting and chewing through it, and we're identifying it as it goes through these levels and acknowledging it as it goes through them, right? One way or the other. Still below 4,200 resistance, no arguing there. But boy, it looks like it's putting a lot more pressure on that than it is support. No doubt about that. So I just don't. I'm just not giving into the idea that we're heading into a recession. I think we have come out of a recession. And I think we're about to head into a period of inflationary pressures where monetary policy is going to be, again, wrong, chasing the banking issues that they created that they don't need to chase by lowering interest rates or pausing them, allowing inflation to take hold again. And then they'll, be clamoring and fighting once again to do that, to throw a wet towel or wet blanket on that fire. So, all right, well, that pretty much covers everything today. I'm cautiously optimistic on the row crops. Hate how we closed, but okay, I'm not throwing in the towel just yet. We have lines in the sand to draw on the chart. I mean, every time we do that, it seems like though they've been going through those lines in the sand, capitulating and coming back up. But that's why lines in the sand exist, is because it's they're there to manage risk, to get out, and allow you to remake a new decision. Crude looks a lot different than it did a couple weeks ago, and our row crops are starting to behave somewhat irrationally, in my opinion, like in terms of the wheat complex. So I am expecting something to change here over the next couple weeks as planters are in full swing, and we're going to start to see how many acres really take and get seed going into them. All right, well, thank you for joining me here today for the strategy of the week for April 13th. I'm Dan Hussey from Zaner Ag Hedge. You can reach me over here at Zaner at 312-277-0110. That's 312-277-0110. You can find me Daniel Hussey Jr. on Twitter, Dan SOTD on Facebook, or shoot me an email at dhussey@zaner.com. Have a great day, everybody. Leave your likes and your comments in this section below. Sign up for our free Zaner daily newsletter, or if you don't receive or haven't been a part of this webinar, sign up to be a member of that mailing list to get the recording and invite link to join this webinar every week. Have a great day, everybody, and we'll be back with you as price action develops. Take care, everyone.